It's interesting. For decades, Japanese government bonds paid almost nothing, so Japanese investors, banks, pension funds, insurance companies faced a simple choice: accept zero returns or invest overseas, and they chose to go global. This kicked off one of the biggest financial flows in modern history. Japan became the world's largest creditor nation and one of the biggest buyers of U.S. treasuries. In simple terms, Japan became a massive source of global money, and this gave birth to something called the yen carry trade. Here's how it worked. Investors would borrow money in Japanese yen at near zero interest rates, convert it into dollars, and invest in higher-yielding assets like U.S. bonds, stocks, real estate, even emerging markets. Because borrowing was so cheap, this became an easy way to make money. Over time, this trade grew to trillions of dollars. It was like global markets were running on cheap Japanese funding. But here's the catch. This entire system depended on one assumption: Japanese interest rates would stay near zero forever. And in 2024, that assumption broke. The Bank of Japan started raising rates for the first time in years and began stepping away from its ultra-loose policy. Suddenly, borrowing in yen wasn't so cheap anymore. Currency hedging became expensive, and the once easy money trade stopped working. That's when things started to shift. When the math changed, the money started moving. Instead of flowing out of Japan, capital began flowing back in. This process, called repatriation, is a big deal because it means less money is supporting global markets. And this is where the real problem begins. For